Is the long bond broken? Hello, Diamond NestEgg members, Super Savers, and course fans. I hope you're healthy and well, and welcome back to our weekly update. So, let's talk about a question that we've gotten a lot lately from our members and bond course folks. This email from one of you is a good example. I often hear the long bond is broken. I have many long bonds going out over 20 years. It concerns me that people say the long bond is broken. I do not understand what that means. Can you give me some understanding and if it should concern me? Before we start today, though, I do want to take this opportunity to thank all of you who've tuned into Markets with Marcus this week and given my better half such a warm welcome to our channel. In case you've missed any of Marcus's recent videos on the latest additions to the S&P 500 index, callable bonds, inflation, and tariffs, I've linked all of them in the first pinned comment below for your convenience. So, here are the three topics I'll be covering today. 1. Is the long bond broken? 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the predicted yields for the upcoming week's treasury auctions? Let's dive in now, folks. Is the long bond broken? The term long bond is colloquial trader speech for long-term treasuries, and often specifically the 30-year T-bond. But a bit of background first. As our Diamond NestEgg regulars know, U.S. Treasuries have historically been viewed as a safe haven in turbulent financial times. Put another way, when equity markets were bumpy, investors could generally in previous cycles move their money into treasuries to keep their cash safe until markets calmed down again. This extra demand for treasuries in times of uncertainty had the effect of pushing prices up and therefore yields down. Remember the old mantra in the bond universe, price up, yield down, and vice versa. And this is also one of the main reasons why many financial professionals, us included, often recommend holding treasuries in a diversified portfolio, especially in retirement. When equity markets crash, as they have done from time to time, holding long-term treasuries may provide a cushion, not just because of the stable coupons they offer, but also because they go up in price. So, instead of selling equities at rock bottom prices during a steep market drop, an investor might be able to sell some of their long-term treasury holdings at an extra gain if they needed the money. So far, so good. And long-term treasuries can indeed be found in many diversified portfolios as a hedge against equity market volatility. However, there have been a few episodes this year where it looked as if this old relationship between equities and long-term treasuries didn't work as expected. Let's look at a chart of the S&P 500 versus the 30-year T-bond to show you what I mean. The light blue line tracks the price of the S&P 500 stock index, and the dark blue line tracks the yield of the 30-year treasury bond. You would normally expect that these two lines move in parallel. For example, when the stock market crashes or when there's fear of an imminent drop, meaning when this S&P 500 line trends downward, the expectation is that people would flee into the safety of the 30-year treasury. And this extra demand would push prices up and this yield line down. And when stock markets are doing well and the S&P 500 is going up, you would expect many investors to sell their 30-year bonds to invest into equities, which would push bond prices down and yields up. When you look at this chart for current year 2025, you can see this normal relationship from late January to the middle of March. Both lines move roughly in parallel. However, there are some instances where the lines diverge when they move in different directions. For example, immediately after President Trump's inauguration, the S&P 500, the light blue line, briefly fell and then rose again, while bond yields, the dark blue line, did exactly the opposite. They rose first and fell after. That said, this specific episode only lasted for a few short weeks, and from late January, the two lines started moving in parallel again, as the Treasury safe haven rule predicted. So, maybe we shouldn't read too much into that one instance. However, for the last few weeks, we have seen this divergence again. While the S&P 500 kept climbing to new record highs, the yield for the 30-year Treasury, the dark blue line, actually went down. This was not what the market was expecting. Remember, falling bond yields mean rising prices, so investors must have kept buying long-term Treasuries even though the S&P was going strong. The market sometimes behaves in ways we do not expect. In any case, this is why there's some chatter in the markets that the long bond may be broken, because yields on longer dated Treasuries are not tracking as the market would have expected under normal circumstances. And as a result, some investors are questioning whether the market still sees U.S. Treasuries as a safe haven in times of volatility, and whether U.S. Treasuries may still be a good diversification tool against the next market crash. So let me give you my personal perspective on this. First, if you're a buy and hold investor who intends to keep your long-term Treasuries until maturity, these price fluctuations in the market will not directly impact you. Under our standard no default scenario for Treasuries, which I use as the basis for my investment decisions, the expectation is that you will keep getting your coupons when they're due, and you will also get repaid in full at maturity. And if you have sufficient cash flow and don't have to sell your long bonds prematurely, you may be in the comfortable position to be able to mostly ignore the market prices and social media chatter. Second, I would not try to overinterpret this year's episodes right now. There was and continues to be so much happening that it's hard to clearly see at this point what was just a one-off episode and what might be the beginning of a new and lasting trend. Only time will tell. And third, when we look at the market movement in September in particular, it shows that the yields for the 30-year Treasury went down, even though the S&P 500 kept climbing. Yes, that's not what the theory predicts, but it's also not exactly a vote of no confidence in the long bond. After all, falling yields mean higher prices. In other words, increasing demand for the 30-year. Investors must have been buying the 30-year. We could even interpret this as a sign that Treasuries are still seen as a safe haven by many investors. For example, those that fear a stock market bubble may just park their money in the safety of Treasuries, and especially on the medium and or long end. Or maybe some investors want to lock in current rates before the Fed starts cutting next week, as many expect, which is also not exactly fleeing Treasuries. But who knows, right? As we always say here at Diamond NestEgg, everyone's financial journey is different. What about you? Drop a comment below. Have you been picking up longer dated bonds, or are you sticking with the short end? Curious minds want to know. So, now that we know what the colloquial term, the long bond is broken, means, let's move on to the next section of today's video. Which Treasuries rose the most and which ones fell this past week? Here's our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Yields didn't change all that much in the big picture, but the movements were a bit all over the place. The 3-month and everything from 1 year through the 7-year were up. The 1.5 month was unchanged, while all the other maturities were down for the week, with the largest changes happening at the very long end. The 20-year was down 7 basis points, and the 30-year was down even more by 10 basis points, illustrating what we just discussed before about the long bond being potentially broken. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. The picture is much clearer here, and it's not pretty. All maturities show lower yields by at least double-digit basis points. This seems to be driven by the widespread market expectation of a rate cut by the Fed next week. The CME Fed Watch tool predicts a 25 basis point cut to a range of 4 and 4.25%, with a likelihood of 96.4%. If you look at the current yields, though, there is a conspicuous dip in the middle of the yield curve. All maturities from 6 months to 7 years show yields with a 3 handle, while both the longer and the shorter end of the range are above 4%. In our mind, this dip may reflect the current uncertainty and unpredictability in the market. Remember again, yields down means prices up. So investors appear to be buying bonds in the middle range of maturities almost frenetically, and especially the 3-year, which currently shows the lowest yield of all treasuries. This likely reflects a combination of the desire to go out a bit longer to lock in current rates before the Fed starts cutting, but also to avoid a commitment for too long to keep the flexibility in case things change again. So let's see how this plays out. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we know where Treasury yields ended the week, let's move on to the next section of today's video. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. The 20-year T-bond and the 10-year TIPS are also on the schedule. Both of these are reopening auctions, so we already know what the coupons will be here. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. Here's the coupon and the expected yield for the 20-year T-bond auction. And here's the coupon and the expected yield for the 10-year TIPS auction. And as a point of reference, this expected yield is higher than the current fixed rate of 1.1% on an I-bond. So, if you're comfortable with TIPS, this may be something to take a closer look at. Bond beginners, folks, please refer back to these 2 modules here on TIPS and I-bonds for a refresher. The break-even inflation rate on the 10-year TIPS was 2.36% at the close of market on Friday. As a reminder, the latest BLS inflation report showed annual inflation coming in at 2.9% overall, and core inflation coming in at 3.1%. So, if the 10-year TIPS fits your timeline, goals, and expectations, you want to add some inflation protection because you believe that inflation over the next 10 years will average more than 2.36% annually, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. And if you want a deeper dive into our perspective on inflation-protected bonds during these uncertain times, come join our next live member Q&A happening this Sunday, September 14th at 5 p.m. Eastern Time, 2 p.m. Pacific Time. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth-building content for your financial journey.